Hi guys, welcome back to my YouTube channel. So in today's video, I'll be making reference to, or I'll be teaching you how you can understand mitigation and also how you can use mitigation in getting 80 to 90% win rate in the market. I'm also going to reference it to how you can make use of mitigation in knowing your directional bias in the market. Now, in today's example, I'm going to make use of Euro USD. And this is my chart on Euro USD at present. The line you can see here is simply called the MTF separator, which is used to differentiate my week, my days, and also the month in the market. So for those that are just joining the channel for the very first time, I'm trading with KC. I've been trading for over 3 years now. So do well to smash the like button, subscribe, and also share this video with your friends because you need this in as much as you are a forex trader. Now, what exactly is mitigation and what does mitigation tell us in the market? So mitigation is a situation whereby any imbalance found within a structure range has been completely filled up. For instance, if I have something like this, price creating higher highs and higher lows, and then I have this imbalance that is formed within this area. Imbalance are simply areas of inefficiency in the market, that is areas where buyers and sellers overlap with each other. So if this is my imbalance, that is, this is my resistance area and this is my support area. Now this has led to the creation of what? An imbalance. So it means that if price comes back to fill up this area and it mitigates the right zone of activation, what we just have here is simply called mitigation. Price created a new high, so any power belonging to this low has now been transferred to this other low. So if I label this A and I label this B, it means that all power belonging to A has now been transferred to B. So if price cleared this high, which we'll call a break of structure, and price wants to continue its bullish movement, that means price is not expected to trade below low B. So price is meant to use any zone formed around this area to continue its movement to the upside. So it means that B has completely mitigated A. Why? Because of the imbalance that was formed around that area. The imbalance has been filled up by B. So that is what we mean by mitigation. Now let's go to the chart and let me explain what I have to explain for today so you can have more winning trades in the market. Now, when Euro USD, let me turn off this indicator. When Euro USD traded above this high right here, we had a break of structure to the upside. We had a BOS to the upside. Now, it means that we can anticipate, or we should anticipate, more buys since we've gotten a break of structure. Now, where is our trading range? Our trading range is from this low all the way to this high. This was the low that led to this high right here. So I'm going to label this as low, structure range A, and structure range B. The low will be labeled as A and the high will be labeled as B. So it means from A to B, I need to find the next area of what? Activation to the what? To the upside. So from this example, it means that our directional bias is equals to what? Bias. Our directional bias, that is my bias in the market, is what? Is bias. That is, I want to look towards price projecting to the upside. All buyers structurally always want price to move to the upside, while sellers always want price to move to the what? To the downside. So since I'm anticipating buy, all I need to do now is to find the next area of activation. And from this example, we have this as the what? As the next area of what? Activation. Now take a look at this. This zone properly filled up any imbalance found within this range. If I zoom in, you can see that any imbalance found within this area has been totally filled up by this particular low. That is, let us identify the imbalance formed within that area. Now, let me start with this one above and this one below. You can see that it has been filled up already. You can see we don't have any imbalance. This low has filled it up. You can see this one here, this candlestick imbalance here has also been filled up by this particular wick. So it means that there is no valid imbalance found within this range. So in case you are confused about how you can pick imbalance in the market, it's very simple. Just note areas where you have inefficiency between your support and your resistance area, and that gives you a clue about imbalance. So if this high is my resistance and this low is my support, they do not overlap each other. That is simply what? An imbalance. And you can see that all imbalance found within the structure range, this internal structure range, has been filled by this particular low. So it means that this low has properly mitigated this low over here, and this low over here has properly mitigated the imbalance found here. Now look at this. Look at this. You can see. You see this long candle, you see that we have imbalances found inside it, and it has been filled up by this particular wick, mitigated the next zone of activation, which is this zone. Now let us now read the mitigation that occurred there. This zone mitigated this zone. This full area here was mitigated by this structure. This structure here got mitigated by this structure low here. Why this one got mitigated by this got mitigated by this. Now I'm going to put a label among them. I'll put a number label among them. So this is low 1. This right here is low 2. This is low 3. This is low 4. Then the last one is low 5. So it means from low 1, 2, 3, 4, and 5 all have proper mitigation with each other. Why are they properly mitigated? Simply because there is no imbalance that is formed inside that particular structure range. For an area to be properly mitigated means that all imbalances found within that area has been filled up. And you can see in this example, they have all been filled up. So it means that a break of one will lead to a break of all of them. Meaning the last controlling demand at this particular period of time is low 5. So I'm going to make more reference to controlling demand in subsequent videos. So make sure you turn on your notification button so that you can be notified when I drop a video on controlling demand. So it means this is the next area that I am supposed to use for my my buy position. This is the next area. So let's see what price did when price got there. Let's see. So let's play it. So I'm going to be a little bit fast now so that it can show. So I'll go to 10x so we can see everything. So let me go to higher time frame. Go to 4-hour time frame so we can see what price did when price got there. Remember what I said, a break of one becomes a break of all of them. So we don't want price to invalidate it. Now price entered inside the zone. We can see a little bit of reaction. So this zone is meant to cause a higher high. If it fails, it means that low 4, low 3, low 2, and low 1 will be totally invalidated in the market. So let's see. Reaction, 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 reaction. Boom. Now, price has invalidated low 5. The moment price invalidates low 5, now you don't need to stress yourself. All you need to do now is be bearish all the way to low 1. That is it. Be bearish all the way to low 1. Why do you need to be bearish all the way to low 1? Simply because the main controlling demand, which is low 5, has been invalidated. In that situation, you are bearish all the way to what? to low 1. So it means that intraday wise, even though my overall directional bias is screaming buys because of the fact that I had a BOS here, from structure range A to structure range B, I had a break of structure. But then internally, because my last demand area, controlling demand area has been invalidated, so it means that intraday wise, I can look for what? More sales to price read low 1. So let's see if that was what price did. So you can see the drop to the downside. Can you guys see? So this is a low. Let me put a line there for what? Low 1. That's it. So let's see. Now, can you guys see? This is price going all the way to the what? To the downside. Boom. Boom. Now, low 1 has been invalidated. Low 1 has been what? Has been invalidated. Where can we now join our buys? Now, look at this structure range here. Can you see that what separates this low? So let me label this low 0. Low 0. Now, do you see what differentiates 0 from 1 is what? Is the imbalance. You can see that we have an imbalance formed from what? From 0 to 1. So that means that this is where price is going to use to create that new high. If there was no imbalance formed here, then trust me, price is going to reach this low. But because of the presence of the imbalance, that means that this guy belongs to a different family. So low 0 is completely different from whatever is happening in low 1, low 2, low 3, 4, and what? And 5. So let's see. Did price give us a bullish reaction from there? Look, our zone has been tapped now. You can see that the imbalance has now been filled. So now we can expect price to be what? To be bullish. So in that case now, I cannot be bullish all the way to this what? This high. So this high now becomes my what? My external high or my target point. And since it is my target point, it becomes my what? My bias. In the market, your target is equivalent to your directional bias. Your target is equivalent to your what? Your directional bias, or your liquidity is equivalent to your what? Your directional bias. So this, I'm expecting price to now trade towards this high to create a new higher high. Okay, this is higher low, this is higher high, higher low, and now we need price to come and read this high. So all the way to the upside, we are what? We are now potentially bullish. So let me go to daily time frame. So that can be very fast. So let's do that now. So in daily time frame, you can see boom, bullish, 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 bullish. This is price doing what it needs to do, and boom, we are out. Can you see price created a what? A new high. So the trend now is higher high, higher low, and what? Higher high. So this is a very perfect example on how you can apply mitigation, and also how you can use mitigation in establishing your directional bias in the market. Take note of everything I outlined here. This will give you 90% win rate in the market to any pair of your choice. If you are trading Nasdaq, if you are trading US30, GBP USD, gold, or any type of currency of your choice, you are going to see a perfect example of everything outlined here. So